Good evening, members. Welcome back to the fourth session and final session for today's day. I would request CA Pramod to welcome CA Rani NR with a floral bouquet. CA Rani NR is a fellow member of the Institute of Chartered Accountants of India. Rani has been a partner in G. Ananta & Co. since 2004 and has experience of more than 15 years in the area of statutory framework related to non-profit sector. She also has authored a book on international taxation and co-authored books on transfer pricing. Rani also has a master's degree in business law from National Law School. CA Rani has spoken at various forums including branches of ICAI and at the Direct Tax Training Institute of the Income Tax Department. Welcome, ma'am, and over to you.
Good evening, members. At the outset, I thank Bangalore branch for giving this opportunity to talk about one of the interesting and, as rightly pointed out by one of the audience members, that complex topics. So the confidence comes from the speakers before me. I saw the senior members who spoke to you about the provisions relevant for the charitable organization. So with that confidence and with that substance what you have heard from them, now my job is to explain the form. So throughout our CA's curriculum and also in our professional practice, we have heard substance over form concept. But now the environment is like substance we give importance. Form also is taking equal importance, especially in times of this faceless assessment. As my partner was, we were discussing, form is the face of the assessee. The officer is understanding the form. Officer is understanding the assessee to the form. So form also takes equal importance. Senior partners of the firm also has to spend equal time in making sure that the numbers are correctly appearing in the forms. Any small error in the form, earlier we were able to explain to the officer the substance, yes, erroneously the number has appeared in say column J, part 4 or something, but now it is not possible. You might get a huge demand just because one number is appearing in a wrong column. So with that context, I don't have much slides here. What I thought is, since the job to me is to have a walkthrough of income tax return 7, which is applicable to charitable organization, I have planned a walkthrough of the utility in the income tax portal. Of course, we have other softwares like Winman or Rely on Sarah or any third-party software which helps us to generate the return for filing. But I thought the source document is the Excel utility which is released by the department, the latest utility. They have not yet released the JSON utility, which is the form in which the return has to be filed, unlike earlier times which is XML format. Now the Excel utility they have released, so we have an Excel workbook where the entire form, that income tax return 7, is there. So each schedules will go through. And compared to the last financial year 2021, this financial year for which we will be filing the return 21-22, there are a lot of changes, some additional information they are asking, which is very critical. And as I told you, we have to be very careful in presenting the numbers. And also what new thing is, till financial year 19-20, along with this return, there was no need to give any financial statements. We just reproduce the receipts and payments account or the numbers based on which the computation is made. Last financial year, there was a need to attach the signed financial statements along with the return. But this financial year, like company returns and partnership firm returns, they have brought in the balance sheet in the as a part of the income tax return. But the thing is, the form in which they have brought in is not specifically made for meeting the requirement or reporting requirement of charitable organization. And as you know, there is no specific format for reporting the making the financial statements for these charitable organizations, which is in the entity's trust or a society. Unlike a Section 8 company, I think the previous sessions you would have heard the various categories in which we can have charitable institutions. It could be a trust or a society or a Section 8 company. So company means we have Companies Act and Schedule 3, the revised Schedule 3. Earlier Schedule 3 had no specific format for reporting for Section 8 company. This in the revised Schedule 3 they have brought in one place they have mentioned in the revenue from operations. They have given a place that if in the case of a Section 8 company you have revenue streams in the form of grants or donations, you have to disclose separately. That was the only place where I saw a mention of Section 8 company. So some of the reporting requirements we get confusion as to whether we should declare for a Section 8 company. For example, shareholding requirement. In the case of a Section 8 company, the shareholders are not allowed to take out the profits in the form of a dividend. So why I told all this to bring the perspective that the form in which we are reporting the numbers is, it is very significant. With that, let me proceed with my slides. So this income tax return. So here this session is about the income tax return. This income tax return, let us have a quick recap. See, we have income tax returns from 1 to 7. Income tax return 1 to 4 is basically for individuals and partnership firms. Income tax 5, you have association of persons. 6 is for companies. Then there is a 7, idea 7, the last return for a special category of assessees. So if let us see how far we are able to identify which form to be filed. I'm sure seeing the people here, all of you are familiar with this. But just a quick recap. Suppose, as I told you, the institution is a trust. If it is a trust and the trust has no approval under Section 12, rather the trust is formed and you have made an application for approval under Section 12, but it hasn't received by 31st March, and you have to file the tax return for the trust as on 31st March 2022. Then which idea we have to choose? 5. Idea 5, correct. Then same way, if it is a Section 8 company under Companies Act and we are awaiting 12 means which form we have to use? Idea 6. So we are all, same with the society also, so we are all on the same page that idea 7 will come only if the entity has a 12 approval. And in this context, there could be a situation which we came across in our office where as on 31st March of 2021, or rather 2020, the company, it was a Section 8 company, they had not got the approval for 12A and there was the due date for filing the tax return. So as you rightly said, we had to file ITR 6. But subsequently, within 1 month, they got a 12A approval. So we had to revise the return and revise the return in ITR 7. So here computation takes a different method. So any similar situation you have means you should plan your income reporting at the time of filing the return, because if there is no 12A approval, suppose the entity has a surplus, receipts minus expenditure in a simple term, we will come to that application 85%, 15% later. Let us assume there is a surplus situation in your income and expenditure account, and as on the date of filing the return, the 12A approval is awaited. Then you have to make sure either if there is a surplus, there is no 12A approval, so there is a tax liability situation, right? And then subsequently 12A comes, there could be a situation where you have not spent, then the computation mechanism changes. If it is a not-for-profit organization, because in a for-profit organization the computation starts with profit as per profit and loss account, whereas when we make a computation for an organization with 12A approval, your computation is based on the gross receipts, and the mechanism is like you will apply 15% and you have to check whether 85% has been applied, and if 85% has not been applied, then depending on the situation we have to file the respective forms, either form 9A or form 10 and resolution and so on and so forth. So these are some basic things I thought I'll bring to your attention. So this ITR 7, coming to ITR 7, this ITR 7 has parts, 4 categories of entities basically has to report 12A approval or any approval under section 10 where they enjoy exemption, any university or research institution or hospital. Then electoral trust is another entity, another assessee, and also political party. So these are the 4 categories of assessees for whom this ITR 7 is filed. In this discussion, we will be focusing on basically charitable trust society or section 8 company and political party and association, maybe some passing reference. So this is a slide like an overall picture, which are the forms. In addition to the income tax return, there are some forms which has to be filed along with the IT return. In fact, forms have to be filed before the filing of the tax returns. This is one speciality for these categories of organizations where there is a situation of shortfall in the application because the mandate on the basis of which the tax exemption is given to these organizations, like a golden principle if we have to discuss at this point. Of course, there are ifs and buts. One golden principle is this income tax exemption is given to these organizations is based on the mandate that the money has to be spent for the purpose for which it has been given. That is the fundamental mandate. So, one principle which we apply in our office is like if any, you may have a very unique situations, even if you read the book or there could be some unique situations where you have to take a decision. The fundamental principle you can apply is what is the mandate based on which the income tax exemption is given. So the utilization of money is very critical in the case of these organizations. At the end of the year, if for some reason the utilization has not happened, then there are these forms. One is Form 9A and another is Form 10, which has to accompany the return. In fact, it has to be filed before the filing of the return. Where the first situation, I think in the previous session they would have told you, where there is a shortfall on account of either the money has not been received or for any other reason, you are not able to spend within March, but you have spent it within the next one financial year, then Form 9A can be filed. The amount you report in Form 9A is called deemed application. It is not accumulation, it is deemed as it is applied in the year in which it is received. And there are conditions that in the subsequent year it has to be utilized. Other form is Form 10. Form 10 is for filed when there is accumulation for a specific purpose. And the timeline is maximum 5 years from the year in which the money has been received. And unlike Form 9A, in the case of Form 10, it has to be accompanied by a resolution from the governing board, either the Board of Trustees or Board of Directors, where they have to specifically mention the purpose for which the money has been accumulated. And this accumulation is specifically captured every year. There is a specific table in the ITR which we are going to see where you have to make sure that the accumulation is correctly reported and the utilization is correctly reported. And one change which we have noticed in the past 2 years, unlike earlier in the initial years, is earlier in the Form 10 resolution or even in the Form 10 and also in the resolution which accompanies Form 10 and also in the computation, we can mention the general objective of the organization. For example, you are filing a tax return for a trust which is into say scientific research or conservation activities. Then you can just, or wildlife conservation, then in the form or a resolution you can just mention that the amount which has not been spent, like there is a shortfall. For example, 1 lakh has been received, 15%, 15,000 can be accumulated and balance 85,000 they have to spend. They were not able to spend 85,000. They have spent only say 60,000 and 25,000 has to be spent for a specific within the next 5 years or next 1 year or 2 years, beyond 1 year. Then Form 10 has to be filed. Now we used to mention wildlife conservation or biodiversity conservation, like that general purpose. Whereas in the last 2 years during the scrutiny notices, they are asking the specific purpose. So you have to be more precise and specific when you commit something that will be accumulated to be spent within the next 2 or 3 or 4 years. This is the complexity in Form 10 and Form 9A. Make sure that the forms are filed before, and in the IT return when you choose, there are specific places where you have to report. For example, if it is a Form 9A case, there is one place where you have to specifically mention that when is the Form 9A has been filed, and after filing Form 10 or Form, that date has to be mentioned in your ITR 7. All these are very critical because any small lapse, though it is a, see when we file the return, the mindset with which we do is, as professionals, we focus more on conceptual issues like whether we have captured the capital and revenue correctly, whether the 85% has been applied correctly, whether corpus donations has been categorized correctly. But the notices which come from CPC, they will have, as I told you, a huge demand just because the Form 10 was not filed before. So it's a very serious thing. These are other forms in this context. 3CF, if anybody has a research association which has an approval under DSIR as a specific research association, you know we have under Profits and Gains of Business Profession, if somebody donates to an association which is approved under Section 35, there is an excess deduction, additional deduction. So the association which has approval has to seek approval under this specific form. Form 3CF has various series, 1, 2, 3, depending upon what category of association you are seeking approval for. Then this is the new form where all of us have, I'm sure that none of us can forget if we have filed Form 10A in your office in the last financial year, thanks to the new income tax portal. The data was not getting saved and phenomenal time was being spent to make sure the form was filed on time. So initially all the organizations which had a 12A registration or a 12A registration had to go through this process to get a, if it is a new organization, we have to seek a provisional registration. If it is an existing organization for a renewal, and most of them have got it also. If it is a new thing for 3 years and if it is a renewal for 5 years. So these are the forms, and the other forms is one as order. Most of the organizations would have got an approval for provisional registration, and 10AD, if there is a cancellation for that matter. I have not seen anything of that sort because as of now most of the organization has got a renewal or a provisional registration. So this is the basic forms, and as I told you, there are some changes compared to the last form. These are some key changes. It was not possible for me to put everything in a slide. Some of the main changes which we came across when we compared ITR 7 of the last year and current year. This time ITR 7, they have not yet released the instructions, so I don't have that. But one good document which you can use is in the IT portal, there is a validation document, checklist. It is a 34 or 37 pages document where what are the schedules or what are the validation what validation happens when you file the return. The utility itself has an inbuilt validation error facility where when you validate it will throw up the errors. But one round of checking that validation checklist is very useful to understand the form, and I thought that is it was a good interesting read for me, to be honest with you. I have never read that validation checklist till now, unless thanks for this session. Because we have a better understanding of this ITR 7 if you go through especially how the department is approaching the subject and how they are approaching the computation and the application. It is a very good document, one round of, little time you can spend on that validation. Of course, the softwares are helping to get out, clear our validation errors, but one round of checking is helpful. So what basically we did, maybe all of you can do is, this is ITR 7 new form, which is notified PDF is available in the portal, and this is the old form. You can take a printout. It is a simple process, and you can compare. That's what we did, so that you can identify all the new tables, and even within the existing tables they have added some additional columns. So next we will go through the actual workbook. That's all PPT for me, with me. Now I am going to show you this is how the Excel utility appears in the IT portal. This form will take you the whole set of schedules which will come as a part of the ITR. Some of the schedules are applicable only for electoral dress, some of the schedules are applicable only for political parties. let's just start going through one by one. So this is like your index, which will take you to the respective. Yes. It's not visible. So, this is like an index. If you are using any software like Winman or even rely on Saral, this is not there. You will not find something like this. There straight away you go to that portal and you will key in the information in a peculiar fashion, and if you generate the output, it will come in the form of ITR 7. So that way, going through this Excel utility is useful to get the flow of the information. First is the basic data, name of the organization, PAN, address. Make sure that your profile, your latest address, all those are captured properly. There is no conceptual issues here. Here the one thing is date of registration, which has come as a part of the renewal process. That date you have to key in. If it is that you are, suppose somebody has only applied for a registration as on the date of filing the return, then that email registration number you can put. Authority, these are straightforward information from the form.
One question here.
Yeah.
Apparently last year there was only this JSON file, the Excel was not there. So this year it has come for ITR 7. Is it the case for other ITR forms also?
Yeah, most of the ITRs they have that Excel utility, but some cases only JSON utility is available. Excel utility is not there. ITR 6 Excel utility is there, but ITR 1 I think there is. But some of the forms they have given Excel utilities.
You can fill up either through that or online.
Yeah, this is like offline filling and then validating enough. Now we have to really see that JSON utility, how it comes. That is not yet released. They have released the schema.
In online now it's so. It will show you the errors, right?
Yeah, it will. Validation errors.
The last, before you submit, it shows many errors.
Yeah. So there, I don't know if I can talk in this forum. Validation errors, the IT portal which shows maybe some arithmetical accuracy. Whether any conceptual error it will show, or whether the IT officer is looking for that error and send a notice and
So, in the earlier code, the JSON portal, the problem is you get the errors only in the end. In this you get
we should try, because every place, no sir, there is a validate button. So see here, if you see here, there is a validate button. So I understand every schedule it should validate, and the way it is like, unless the validation happens in some one schedule, there is at the end of the return, which we are going to see, there is a like our computation where full thing will flow, and for example, it is as per item number 8 in schedule J, like that it is cross-checking. So unless your schedule J is validated, the number will not flow.
Previously, ITR 2, which was this non-residence, never used to be online, I think. We used to file only
XML, the advantage is like after generating XML, we can really see the data. I'm not sure. I don't think it is possible. So the first sheet is pretty general information. We have more detailed things to discuss while just going through. Here again, audit cases. So when audit is applicable, audit report under form 10B, when the gross receipts, when the total income, total receipt of the organization is above the taxable limit 2.5 lakhs, the audit is applicable. So the details of the chartered accountant, all those assets are all same thing actually. There is nothing new. Whatever we had in these places, there is no new information. It is the same. It is the same as last year. So here, one place is like this details of author, founder, trustee. This it was there in the last term also. That shareholding of 5%. In the case of the Section 8 company, under the Companies Act, we have to declare the shareholding above 5%. That they have brought in the new ITR 7. The heading is like, in case if any persons as mentioned in A above. A above is the trustees and the shareholders. is not an individual, then provide the following details of the natural persons who are beneficial owners, 5% or more of such person, as on the date of the application. This is the new thing in the new return, where they have envisaged a situation where a person other than individual is a member, maybe in the case of a society, and in that case they are asking if they have more than 5% holding. You have to give the details, name, resident in India, what is the unique identification number, ID code, address and percentage of ownership. This is a new thing which they have brought in here. Other than that, in this sheet there is nothing new. Next, Schedule I. This is, here we have new. So here, this is accumulation. I think that you had a session on accumulation, right? I assume that you understand what is accumulation, 85%. So the money what you accumulate or set apart to be utilized for future purposes has to be invested in a specified mode, as mentioned under section 11.5. So if it is not mentioned in that specified mode, it is a violation. So here, unlike earlier table, there are additional columns. So these were there in the previous return also. Financial year wise, accumulation, what is the purpose of accumulation, how much you have in the beginning, how much, what to be applied and what you have applied, and amount applied for, so up to column 6, if you see, amount applied for charitable or religious purposes in the previous year, for the purpose for which it has been committed. Then other two, column 7 was also there, amount applied for purpose other than charitable purpose. So other than charitable purpose means it becomes your deemed income, it goes your taxable income calculation. Then this is a new thing. Everywhere, even in the application of income, we will come across that. If out of the application, if you have paid any donation to other organization, see in my example, your assessee is a trust which is engaged in wildlife conservation, and from the income of the year, from the receipt of the year, if a donation has been paid to another organization having 12A registration, then we used to show it as a part of, say, preservation of environment only. We never used to show it as a separate category, but in this new return, they are specifically capturing the money paid to other organization having 12A approval or any approval under section, any exemption under section 10. So this is one new thing. Amount credited or paid to any trust or institution registered under section 12AA or AB or approved under subclause 4, 5, 6, 6A of clause 23 of section 10. Why? Because, why this new clause is because if you make any donation out of your accumulation, it is not given as an application. Any donation has to be given only from the current year receipts. You cannot give donation from your previous year accumulation. If you give a donation, it is not considered as an application, so it will not be given the benefit. So that is why they want to capture this separately. So be very careful during the course of audit. You have to ask a specific question, because sometimes what happens in the books of accounts, this may not be so clear. They would have put as a part of other donations. So this one question we have to ask as auditor. This is a new thing, and this is the new table here, this clause 8. The balance is a formula. Once you fill in this, the numbers will flow. Then here, balance amount available for application, this entire thing, after 8, whatever you are seeing, 9, 10, 11, 12, 13, this entire table is new. This was not there in the previous this thing. So amount, here only they want you to commit where you have invested the accumulation. Amount invested or deposited in the mode specified in section 11.5. Amount invested or deposited in the modes other than section 11.5. If you have invested in a mode other than section 11.5, the number will flow from here automatically to your final computation sheet. So this is one new thing they are capturing. So we have to be very careful. Amount which is not utilized during the period of accumulation. So all these categories, 10, 11, 12, all these are like a non-compliance with the section 11 requirements. Then 13 is 7 plus 8 plus 11 plus 12. So these are amount deemed to be income within the meaning of subsection 3 of section 11. Yes.
It's not 100%, and you scroll so that you can see that. Otherwise, we are just already just here.
You can't see this now?
No, yes.
Yeah, you can tell me that. I can't see what is happening.
Yeah.
Yeah.
Madam, can you send it through our emails?
Yeah, this will come. Actually, this is there in the income tax utility portal, sir. Yeah, I will show you that. It is very simple. You can just download it. I did that a simple process. We will anyway share it with you also. But it is available there. So this last column is important. 13, amount deemed to be income. So from this accumulation table, earlier time they only captured what was the accumulation year-wise, how much you have utilized for the purpose, how much is unspent, yet to be utilized. They never linked it with where the money is being parked. Now they are linking it with the modes of investment and also if it has been utilized for any other purpose. And straight away from this column 13, it will go to your final computation, which is a deemed income. So this is an amendment. Any questions at this point? I think we will discuss the questions here and go forward.
This accumulation means what type of items you can accumulate?
So accumulation word is like the shortfall.
Shortfall, correct.
Shortfall.
What would have-
The purpose, like basically, if it is for, basically you have to use it for the purpose of the organization, charitable purpose. If you are accumulating, you have to be more precise, specific. As I told you, see in the case of some organizations, this accumulation can happen because they have got, now let us see what are the different revenue streams for organizations like this. Basically the revenue streams will be general donations or some of the organizations might be getting grants, which is specific budget line for a specific project. So if the money has come to the bank account, say last week of March, major say 10 lakhs, and the project is about to start from the next financial year. As on 31st March, that 10 lakh is sitting in the bank account of the trust, which is to be spent over the next 3 years. So when you make your computation, your gross receipts includes the 10 lakhs which has come to bank account. On that 15% is allowed, balance 85% you have not spent the money and there is a shortfall. Now this particular money, the organization should know that what are you going to do with that money. Now as on, let us assume this similar situation was there in the previous financial year. As on 31st March 21, this situation happened. Now when you filed Form 10, you told that this will be spent for a particular project in the next financial year. So this year what happens, opening balance accumulation will come, that unspent money of the previous year. Basically, accumulation is nothing but unspent money of the previous financial year. And out of that, how much you have utilized. You still have a situation where if the project is running across 3 financial years, you still have a situation, you would have got the next tranche. See, when people work in a grant mode, what happens? The money comes in tranches. So the first, there will be a sanction for the whole amount, say 1 crore, and the money comes in tranches by the grantor, and depending upon the utilization of the tranche, the next tranche of money comes. So unutilized money, basically your unspent money, will be, now the mandate is like whatever money you have not utilized, for which you have not discharged your obligation, has to be kept in a specified mode under section 11.5.
Basically capex.
Not necessarily capex, even salaries also can happen, sir, because depending on the period of utilization. See, in my example, the project period, the project budget, let us assume the project budget will have capex plus salaries, travel, your project, your consumables, contingencies, everything. Yeah. So sanction happens for 3 years, but it is executed over a period of 3 years, 3 financial years. So since there is an artificial cutoff and your project cutoff, project timeline cutoff, and your financial year cutoff will be artificial.
No, if the project is fine, generally.
General donation.
No, generally you are unable to spend 85%. Can we make some like a tax planning? Can I say that, say, shortfall is there 100, okay? And that 100, can I say that I will spend that so and so capex next 5 years?
So that is a so and so capex is a general.
There is no government grants and all.
Understood. Now capex is, you are telling a purpose. No, there is a purpose like we will spend on say building or we will include the infrastructure. That is fine. That is fine. The purpose should be very precise because at the time of assessment they will come and ask you have you spent for the same thing.
Same.
Yeah. So because we will file the return now and after within 1.5 years the scrutiny notice will come, they will go and ask, okay, you have committed this purpose, show the actual utilization. In case you are not able to utilize for the purpose what you committed, you should have a valid reason why you should.
Form 10.
Form 10.
9A?
From 9A actually they are not asking the purpose actually. There the assumption is like you are not able to spend, either the money has not come to your bank account or for any other reason. See, we had a case where the organization is into medical care, medical relief, and they had a project from to spend money, but because of COVID they couldn't do. So what happened? By the time we filed the return, we knew that the money has to go back to the donor. So we mentioned any other reason and say that they couldn't get the licenses to do the work in India because of COVID. So such situation can happen.
Madam, if any person who is giving donation, PAN number is mandatory for which amount and above.
So PAN number is mandatory, but in the new form, the recent form they introduced, form 10PD, they have asked other than PAN, some numbers also are allowed, like your Aadhaar number or passport number can be given. Now the understanding is, first all of us understood that form 10PD is to enable the donor to claim a deduction under section 80G. But now when the form they released, we find that other than PAN number, some other unique identification number also they are asking. So it may not be only for the purpose of enabling the donor to take an 80G, it may be for the future of the idea of the department may be to map the gross receipts. So to answer your question, basically what details we need to collect is to make sure that tell the department that it is not an anonymous donation, sir.
No, but which amount, up to what amount it is exempted, this particular?
There is no exemption on that. They have not told that no need of PAN number up to this amount of donation. No, nothing.
And that is also is required.
Yeah, there is no donation. So the thing is, if they don't give the PAN number, they will give you passport number, means for the recipient organization it is not an anonymous donation.
No, individual.
In individual also. Suppose the individual has no PAN number. So they may not be willing to give the PAN number, for example. They may not be willing to, they will say, I don't want the deduction under 80G, I am not willing to give the PAN number. But you have to make sure that you have any other identification number and address and phone number and all those. Because as a recipient organization, it is your onus to prove that it is not an anonymous donation. Yeah. Especially when nowadays organizations are getting money in that online platform, Give India Foundation, all those, you have to make sure that you have the details of the donor. Otherwise, it is a problem for the recipient organization because it will be taxed as anonymous donation.
So any difference in the taxability of anonymous and non-anonymous?
Yeah, of course. Because non-anonymous donation is like voluntary contribution, you know the donor. Anonymous donation is taxed at a higher rate, 115 is taxed. You don't get the benefit of section 11 for anonymous donation.
Even it is collected for a specific purpose, like building donation.
Donor details you need.
So the 85% need not be applied on the anonymous, right?
So because the point of receipt itself is taxable. 85% is relevant only when you enjoy the benefit of section 11. Even if you, the other side I'll tell you, even if you spend 85%, he will not give you the benefit.
115B.
BBC.
From the point of view of the donor, there are some, as you rightly said, there are some of the portals where you go and click and donate and all that, it takes you to the bank portal and pay the amount. But it doesn't ask for PAN numbers. So how do you...
See, when many of the organizations work with some facilitator who does that categorization. For example, they make a categorization of FCRA donations, non-FCRA donations, and as a part of the format itself, they ask the basic details from the donor. Like, for example, if I have to donate to an organization, in the portal itself, that facility is there. Basic information you need, especially for organizations having FCRA registration, but to make sure that the source is a foreign source. If it is a foreign source, it has to hit the designated FCRA account of the recipient organization. Somebody can't donate without giving the basic details.
No, my question is, some of these portals don't ask for PAN. I'm not talking about FCRA, I'm talking about resident donation. But this year I'm told that the donation which is made is mapped to the donor's ITR. So when he downloads, he actually shows what are the donations he has made.
Provided he has given the PAN number.
No, but okay, fine, I agree, but I don't know, I have to check that. I don't know whether it's working, maybe some of the can elucidate.
As of now, it is not coming in 26 AS. If you see the individual returns today, in the 26 AS, none of the donation details are coming.
Is it coming at the time of filing the return?
No, we file some of the returns. We are still going back the old method, asking for the receipt and keying in the PAN details. But it is there. It is going to come. And non-PAN case, I think they will be more serious.
No, the problem is they can be more serious, but the problem is not on the donor. The donor, obviously, if he claims 80G, he will always...
The problem is the recipient organization.
The problem is they have not enabled the portal to capture the PAN. I mean, think there was a previous speaker who spoke, and he's a trustee on the, I'm going to write to him, on the TTD. One of the, TTD has got many trusts.
But TTD is a religious trust, no sir?
Yeah, but
for them that anonymous donation rule is not there. For the charitable organization, because only collections are there.
But listen, unfortunately, it doesn't capture.
should finish the presentation,
Yeah, okay.
then we can
Okay.
take it, because
Sure,
we
sure.
are running short of time.
Sure. So Schedule I, this is the additional requirement. Now moving forward, Schedule D. Schedule D is exclusively for deemed application. Deemed application is Form 9A, where two situations. One is for where the money has not been received or any other reason. Where the amount is not accumulated, it is considered as a deemed application. But there are conditions based on which you can file Form 9A, where you have to spend it within the next 1 year, next to previous year from the year in which it is received. So here they are asking year in which deemed applied, amount deemed to be applied during the previous year, reason for deeming. So here in the drop down it will ask, it will give you income has not been received or any other reason. Then please enter the reason if it is any other reason. Out of the deemed application claimed, amount required to be applied during the financial year pertaining to current assessment year. So here last year you filed the Form 9A, out of that how much has been fully utilized. If there is any unspent money, again it will come as non-compliant of section 11. Amount of deemed application claimed in the earlier years applied during the financial year. These are all not new, because it is like earlier so much detailed requirement was not there. Now they have introduced this table. This entire Schedule D is new in the new return, which you have to specifically mention what happened to the money or number what you have committed in your Form 9A. Amount which could not be applied and deemed to be the income. So if you have committed in Form 9A in the previous financial year and you were not able to spend for which you have committed within the timeline allowed under the respective section, then it is deemed to be an income. Amount which could not be applied and deemed to be income under section 11(1)(b) during the previous year. Then balance amount. Applied income being exemption claimed in the earlier. So if you fill in all this information, as I told you, the form is designed in such a way that whatever taxable component will flow to your computation. This table is new. Then next is Schedule J. Schedule J is about statement showing the funds and investments, the details of your investment, where you have put your money, your corpus donation, opening balance, received during the year, applied during the year, then again the investment details of the corpus donation. So here, if you see here, this statement, is it visible? Statement showing this statement showing the funds and investments as on the last day of the previous year. So where basically the details about where the money has been parked. They want to make sure that you have complied with section 11(5). That's the purpose of this table. So you may have to capture the information in depth. Because earlier, the money has been invested or not, we might ask a question. Now you have to really see how they put in the specified mode under section 11(5).
Key requirements of these forms or schedules, like some FAQs.
Sir, kindly ask in the last, sir.
Sorry?
Kindly ask in the last. Let the session go over.
Yeah. So I'll answer your questions in it. So details of loans or borrowings. This table is new because this loans and borrowings has an importance. Even for that matter, corpus has an importance. There was an amendment where they told that if, as you know, corpus donation at the point of receipt, the stricture of 85% is not applicable. So if the organization receives corpus donation under section 11(1)(d), we enjoy an exemption. But at some point of time, corpus, as you know, is a donation given by the donor with a specific instruction. It forms part of the corpus of the trust, or it is an endowment. Now, at some point, the organization is in a situation where they have shortfall of funds, and with the approval of the donor, they have to break the corpus FD. The corpus donation, as you know, has to be invested in a specified mode. If at any point of time they have to use the corpus fund to pay the salaries, which happened for some of the organizations in this COVID period, then they have brought in an amendment saying that the organization would have considered, you would have used that money to pay for the expenses, but it will be considered as application only in the year in which they have recouped they have put the corpus money back. So that is the year in which they can claim it as application. That is why even the same rule applies for loans and borrowings. So if somebody has made an expenditure from the borrowed money and the application of that can be claimed only in the year in which the loan is repaid. These are the amendments. So these tables are specifically to address the utilization of corpus fund and also the monies from loans and borrowings. This is one new thing you have to be careful. So this table is the result of that amendment. Other than that, going forward here, there are no new things. All other tables are same as the last year. Basically, the amount of investment, details of investments or deposit under section 11.5. So there, corpus investments. If you see the balance sheet, if you can imagine the balance sheet of any organization, there will be corpus fund, general fund. For simplicity, I am saying. Corpus fund should be, you should see ideally in ideal world, the corpus fund money, you should see the same number or amount more than that in corpus investment. So in the balance sheet, you should be seeing corpus fund and corpus investment, and general fund can be in the form of any general investment, and also it can be simply in the form of advances or in the form of it will be sitting as a balance in a current account or a savings account of the organization. But you have to make sure that the corpus fund is in the specified mode, FPs or allowed modes. Okay. So that is why that everywhere they are asking corpus, they are capturing the details there. So the work as an auditor is in the case of the financial statement. Suppose all the FDs have been parked only under cash at bank in deposit accounts. One number if you see means we have work here. Out of the FDs you have to take out the corpus FDs and that that demarcation should be there. So if that homework has not been done, suppose there is a spillover or some together a portion of the corpus and a portion of the general fund has been made to round off into one FD, you will have some, you have to apply your money. That is the practical work which I can think at this point. There is a FD to be made, say 1,75,000. What the organization would have got another 25,000 or another 1 more lakh, and they will round off to 3 lakh and make an FD. Now when we make the reconciliation, you will have a situation out of this 3 lakh FD, one portion is corpus and one portion is non-corpus. Such kind of homework we may have to do. Now this is a next one. This is totally new. As I told you, last ITR 7 we didn't have to give balance sheet as a part of the income tax return. So here really we have challenges because, as I told you, there is no specific format for balance sheet, especially if the organization is a trust or a society. So here one main observation here is, see, this balance sheet is in the form of source of funds and application of funds. Now if you see source of funds, they have used an expression own funds. Okay. So in our common understanding, what is own fund? What is my savings and what is my capital, right? Normal, if you say take a company, share capital and reserves and surplus is our own funds, right? But here, the way this form has been designed, own funds includes the not only the general fund. In the case of organizations where they get grant, let us take a situation where other than general donations, no doubt, general donation will come as an income at the point of receipt because you are free to use that money. When you say general donation, the organization is free to use the money for the purpose of the trust or the company. There is no stricture from the donor as to what they have to use it for. They can use it for capex or opex. Only thing they have to make sure it is used for the objectives of the organization. Whereas, if the organization has grant money with a specific budget line and a specific purpose, then at the point of receipt, if we see, of course, accounting standard applicability is a question, but if you see the principle, grant money comes with a specific direction that it has to be spent in a specified manner and for a specified period, and there is an obligation for the recipient of reporting requirement to the donor. They have to give utilization certificates, and any unspent grant at the end of the year, you may have to give back to the donor also. Such cases, at the point of receipt, is actually you are not free to use the money the way you want, and there are organizations which we come across where they treat it as current liability. Project fund at the point of receipt is accounting wise, it is treated as current liabilities. In the computation, they will consider as a part of the gross receipt. Both the general donation and the project grant is considered as gross receipt, less 15%, 85%, and all the expenditure, including the expenditure out of the grant and also general donation, considered as application, and met with the computation fine, fair enough. Even receipt and payment account also will have that classification. In the balance sheet, if you see, for such organizations, the unspent general donation, any surplus earned out of the general donation will be going to the general fund, and any unspent project grant, most of the organizations report under current liability because it is an undischarged obligation. Now, if you have a balance sheet with that format, if you see this balance sheet, here in the current liability, there is only two categories, sundry creditors or other payables. The unspent project grant, undischarged obligation is neither a current sundry creditor nor a payable. It is actually money, a voluntary contribution. Basically, at the point of receipt, it is a voluntary contribution for which the obligation is to be discharged. So, the income tax of this bonds, that also to be reported under own funds. So, there should be, conceptually we understand the project grant, actually the organizations who receive the grant, they don't call it as own fund because in their head, if you see the technical guide of the institute, our Institute of Chartered Accountants of India, there is a technical guide for reporting for charitable organizations where they have given a format. If you see that format, there are two columns, restricted and unrestricted. The restricted is the fund which comes with a specific obligation to discharge and specific way it has to be spent. Whereas unrestricted is your general donation where you can spend it the way you want, especially for the objectives. But in the computation under the section 11, which is a deeming fiction actually, the computation which is prescribed under section 11 is a deeming fiction where they told that whether it is in the form of grant or donation or your interest earned on the fixed deposit, it is a gross receipt for the organization on which you are supposed to spend the 85%. Now there is a deeming fiction, computation based on deeming fiction. There is an undischarged obligation which is reported as current liability in the balance sheet. Now here is a balance sheet where it is asking all the voluntary contributions including the grants or general donations is called as own funds. Because you as a recipient, you have collected the money with an intention to spend it for the objectives of the organization. So you have to revisit your balance sheet and see here, own funds have various categories. If it is visible here, this you have to apply your mind. Own funds is not only the share capital, and ideally in my head I would have thought own funds should have my corpus fund and maybe general fund, correct? I cannot have an unspent project grant. But here it is not, he is not showing that way. He is saying corpus fund out of the donations received, yes I understand, with a specific classification. Even in the corpus, he says corpus received for repairs or repair of the places under section 80G2B. If you get any corpus with a specific category, you have to report separately and other corpus. Then mandatory application, you see here, income accumulated out of non-mandatory application 15%. This is nothing but, this is a balance sheet we are talking. Whatever the organization has accrued over a period of time out of the general donation and any project grant where there was an unspent money and the donor told that please keep it for yourself, you don't have to give it back to me. So whatever the organization has earned, that 15%, they are free funds, that 15% is their free funds, right? They don't have they can keep it for themselves, it is not part of the 85%. That has to be reported out of your general. So basically, correctly that general fund, whatever general fund is your 15%, then income accumulated under third proso to 1023C or section 11.2. Here, the accumulation. If you have filed Form 10 in the earlier years and you have committed for next 5 years and this is your third year, another 2 more years is there to spend what you have committed 5 years back. That is sitting in your balance sheet, right? As unspent money. You have an obligation to spend it, right? It could be out of your general donation or out of your project grant. That has to be separately categorized. Then balance amount of deemed income being exemption claimed in the earlier years on account of deemed application required to be applied in 22-23 onwards. So this is again Form 9A. Any unspent money out of Form 9A. So the clause D is accumulation Form 10. Obligation pending to be discharged under Form 10. Then any deemed application yet to be complied under Form 9A and any other reserve. So here there is a reconciliation you have to do from your balance sheet. Out in the balance sheet you see the liability side other than your statutory liability. If it is a cash method of accounting which most of the trusts and societies follow, you will not have any payables, you will not have any expenses payable or outstanding expenses. Then ideally you will have corpus fund, general fund and maybe some unspent project fund, or if the organization in the practice of not categorizing project grant, or if they don't have a grant, they will have only corpus fund and general. Suppose if it is a section 8 company where accrual base of accounting is mandatory, imagine the liability side of the balance sheet. Share capital, reserves and surplus, then you will have long-term liabilities, then non-current liabilities, current liabilities, statutory liabilities payable. Now from all these places you have to identify where is your money sitting to report here. That is one work we have to do. That is my first feedback on this form. It is not as, you can't simply reproduce what is there in the balance sheet. It may be pretty simple depending upon what format you have followed. Especially trust and society, I find it more easier, but for section 8 company we have a challenge, because you would have made provision for gratuity, deferred tax liabilities, all those will be there in the balance sheet, because compliance of accounting standard is also mandatory. So this is something which you have to apply your mind. This is a new thing. This is the main thing I wanted to discuss with you. Then other than that, if you have any borrowings, again out of your in your balance sheet you have any secured loan, unsecured loan. Here you make sure that you have a separate table for loans and borrowings. Any unspent, any closing balance coming out of that table there should be a matching here. Here I don't find any, I don't know whether that table, I don't think that validation is happening between the closing balance. But we as accountants, we have to make sure that those numbers match. There is a closing balance, unspent money from your borrowings. Obviously your closing balance of borrowings here, what you are reporting should match. Then advances, this is a normal advance under current liability. This is the challenge is in source of funds, total source of funds. Application is pretty simple. Your fixed assets, then investments. Here cross check can happen. In the earlier tables we saw investments, corpus specific investments, investment of general fund, investment of unspent deemed application, all those total and the classification here should match. There should be a cross check. There cannot be difference in the numbers. So these are the things you have to be careful. These are your, maybe you can call a self-assurance checklist. You can make a checklist in addition to the validation errors. You have to make sure all this. Other than that, current liabilities, other payable, this is as I told you, as I think most of the trust and society cash base of accounting, this you won't find any number. If it is accrual base of accounting, you will find some number here. This is all about balance sheet. Then next, so this is fully new, balance sheet is fully new. Then this is a schedule LA is for a political party. Unless somebody has a specific question, I would like to skip this portion. Then next is for electoral trust. This schedule is for electoral trust. Then next schedule is this is voluntary contribution. Here only that here no major changes. Domestic contribution and foreign contribution they were separately asking in the previous returns also. The only change is corpus donation. Out of the earlier there was only one line item for corpus donation. Here they have made a distinction of corpus representing the donations received for renovation or repair of places notified under section 80G2B. So this is a separate category. Other corpus. Then so here corpus donation received during the year will come, which will be reported as a part of the corpus table which we showed there. So that is a cross check you have to make sure. So this is the voluntary contribution. So this is only new. This A and B. These two sentences are new. So visible there behind. Yeah. Other than that, the rest here foreign contribution. Again, foreign contribution they have brought in that line item. This is new. Then here one line item they have put here. Specify the purpose for which the foreign contribution has been received. This is one thing they have brought in. Then other than that, there is nothing new. Coming to next. So all the reporting about voluntary contribution. Then here schedule AI. This is other than the voluntary contributions. This is pretty much the same. No change. Here the only change is, as I told you, any payment, you see this line item B2. Donation to any trust or institution registered under section 12. This is a new line item. where they want to capture the cross donations. They want to make sure two things. One, maybe rather three things. One is the money is not out of accumulation. Second, it is actually paid to an organization which is having the specific approval. And third, they might ask the purpose, like there should not be too much, somebody is in conservation, they should not be giving to, not at all relating to the objectives of the organization. They can question, that is what I am thinking. They might go back to the original objectives of the organization. It cannot be too far from the fundamental objectives of the organization. These are the three things which you have to be careful, is in my opinion. Other than that, it is pretty the same thing, relief of the poor, all those things. In this context, one thing which is not a new thing, since we are discussing ITR 7, I wanted to share one thing. See, if you see here, the application, the schedule is entirely for schedule ER, is actually expenditure revenue, that is ER. Amount applied to the objectives of the organization. Here fundamentally they are making two distinctions. One is establishment, expenditure towards establishment and administrative expenses. Application for establishment and administrative expenses is captured under these specific heads, and down the application is captured depending upon the nature, depending upon the specific limb in the definition of charitable purpose under section 2 subsection 15. Under 2 subsection 15 charitable purpose is defined, and the organization for which you are filing the return, under which category they have got approval, you have to see. So the total application is bifurcated into two categories, establishment and administration, and the objectives. Okay. See, as of now, FCRA has come up with a limit. The administration expenses cannot be more than 20% of the gross receipt. Earlier it was 50%. In the amendment they have brought in 20%. So they want to make sure that the money which has come has been utilized for the objectives for which you have been given the mandate, not on administration. When we say administration, non-core, see all the supporting staff, including the statutory audit fees. Statutory audit fees is an administration expenditure. Then fundraisers cost, HR cost, and fancy officers. See, if the project is happening in a field station, the rent paid to a field station will be a project expense, whereas a rent paid to an administration office is a problem. So these are the value adds which we have to bring attention to the client. Client is careful about FCRA. As of now, till now, the income tax officer has not asked the question, but I am very sure that the moment they are asking this classification, if the number reported under specific objectives is smaller and the number under administration is pretty big, definitely they are going to come back and question the, why you need to spend on administration so much. So you have to be alert and you have to make the client understand. This is nothing new, but I thought I should share this. Then other than this, in this nothing specific. Here expenditure allowed as application, as I told you that donation paid to other organizations, they have specific line items of various categories. If you see here, these are new. Donation to trust or institution under section 12A approved under section 1023C, relevant clauses. Then, so all these sections we have to see whether the recipient of the organization to which your client has paid is falling in any of the specific category, and you have to list out in the specific place, not having same objects. So including the objects of that recipient organization, you have to find out. This is a new thing. Then other than that, in this, again here if you see line number 6 for income of earlier years, here borrowed fund and corpus. This I told you it is a result of the amendment of have you plowed back the corpus and have you put the borrowing money back, only then it will be given as application. Then this is that's all. Then here in schedule is E. EC, the new requirement is that income, this new thing, new clause is there here, source. So out of the application, earlier also in the return there was, after the total application they will ask you to say the source. Is it out of current year receipt, or is it out of earlier accumulation, or is it out of borrowed fund? That source they were asking, you have to tally that utilization. In addition to this, these two lines they have added. One is 11.2, line number 2, 11.2 of earlier years. Income accumulated under section 11.2 from the earlier years. So out of the total application, how far you have spent out of the earlier accumulation is one thing, and corpus and borrowed fund, again that distinction they have brought in. Then that is the amendment in this. Going forward, This is there in the previous return also. Total receipts including voluntary contribution. This is not applicable for entities having section 11 exemption. This table is exclusively for the organization having exemption under these respective sections. So this is not new. Then we have, this is also again, this table is scheduled IE2 is only for the assessees claiming exemption under section 1023A or 1024. Then next is again specific reporting, not for section 11 entities. This also. So if you see here, it is IE 1, 2, 3 and 4. Then, actually, here, from here onwards, if you see after this, you will find all these schedules are relevant if the organization has taxable income on account of the violation of section 11. This is a situation where that's what I can think, where the entity has 12-way registration. In that particular year, there is a non-compliance of section 11. Then there could be a reporting requirement of the income under the specific heads. See, in the case of organization having approval under section 12, the deemed fiction is like property held under a trust. So if any rental income or any interest income earned, we will report as a part of the receipt, rent, commission, even capital gains, net consideration. It is not mandatory they should claim exemption under section 54. Section 45 we don't read. PGBP, Profits and Gains of Business or Profession chapter we don't read unless they have a separate business and separate set of books of accounts. Right? We will show rental income, we don't claim that standard deduction of 30%. All those will not come. That is up to this, okay? But the next all the schedules, if you see here, it is like normal house property income, normal income from other sources, normal capital gains. So here, one critical question in one of this is, do you have a taxable income in one of this schedule? When you see, if you see here, you are seeing here one question. Income and expenditure statement, there is a question, do you have any income which is taxable? For some situation, one situation which I can think is, entity has 12-way registration, but in one reason, one year there was non-compliance of section 11 and 12A is still valid. If 12A is there, then you can't file any other form. ITR 6 or ITR 5 you can't file. You still have to file ITR 7. But you have a situation where you have a taxable income. In that case, what happens? You can't declare your rental income under that section 11 computation. You have to declare under the regular house property computation. Understood? You can take this form and make a study. It is I could think of one situation where if the organization has approval as charitable organization under any object of general public utility, out of the links, any object of general public utility is one of the links. In that, there is a condition that out of your gross receipt, up to 20% of gross receipt, you can have commercial receipt. Commercial receipt means there is a quid pro quo. And quid pro quo means, unlike a voluntary contribution, what is the difference in a voluntary contribution? The person who pays the money is not the beneficiary, right? It is given for public beneficiary. Whereas commercial receipt, there is a quid pro quo. I do the audit and I get the audit fee. I do the consultancy and get the consultancy fee. Such receipts, up to 20% of the gross receipt is allowed under 2 subsection 15 subclause proviso. Whereas, suppose in one situation, 1 year, you have a situation where the gross receipt from business or that exceeded 20% of your gross receipt for whatever situation. That year you are still a 12-way entity. You have not violated it. It could be a unique situation. You can explain to the officer. He may not take your 12-way if you are able to explain why it happened. Only thing is, if it has exceeded, you will explain, and if the officer is satisfied, he may not revoke your 12-way. Correct? So in that situation, what happens? You are attracting that business head, and there you will not get the computation will not fall into that section 11 format of 15% and 85%. That you may have to report under the regular business income section. Understood? This could be one situation I could foresee where if you have a taxable income, and the question is, do you have a taxable income means you are out of section 11 computation. This I thought I should tell you this. So all the other regular computation tables come here. Your set of and carry forward losses, house property has 30% standard deduction, capital gain has section 45 format indexation, and DTA, special rates, all those things comes as a part of this idea cell. That is something which you can take a printout and go through this. Other than that, I didn't want to talk much about it because basically the idea is to enable all of us to file idea 7 where they enjoy section 11. If you have a unique situation, just wanted to bring to your attention that there is a place in the return where you may have to see where you have to report. And finally, where it all comes, that is the most interesting part. All this came, investment, 115 new, your statement of income, here, finally all the table what you filled up in the earlier schedules will come and fall in something called, I wanted to show you, I will come back to the schedules. Here, all the table, if you see here, this is where the total income is getting computed. Okay, so here, your voluntary contribution, your deemed income, whatever money you have not spent, everything is captured. It flows from various places. Of all your earlier tables, it will flow here. So this is like a summary. This is like your summary of all the earlier tables. It is visible here. And finally, all the categories are captured here. See, if you see here, they are referring to the respective schedules here. Is visible behind?
Yes,
So respective schedules they are addressing here. So whatever you have filled up, for example, the first number flows from your schedule relating to voluntary contribution. So like this it will flow, and whatever taxable component also will flow here. If you see this as a computation, just like we make computation of total income for an individual, we capture all the heads of income separately and then we arrive at GTI less deduction total income. Same way, this is a beautiful part BTI. You have to, it's a beautiful summary of how the whole income flows. This is, I think if you see this Excel utility, this understanding is very, very interesting. And from there, he finds the total receipt and what all the income tax officer can add back, where the benefit of section 11 is not given. What can come to your taxable income, what can contribute to your taxable income, even if you have a section 11 exemption. Where are the situations where there would be a taxable income coming for such an organization is captured here. 11(1)(b), where the purpose has not been met, where the money has been spent for the purpose other than for the purpose for which it has been accumulated, or where the money has not been invested in the specified mode. These are the respective sections, or 13(1)(c), which Suresh sir was saying, where the money is paid to a specified person for his benefit and the reasonability is questioned. It is a violation of section 13. Actually, section 13 specifically talks about situations where section 11 do not apply. That section heading is like that only. Section 11, where in what all situations you cannot enjoy the benefit of section 11. All those are the additions. And if you remember in 2019 Finance Act about the amendment, that TDS, if you don't do TDS under section 40, there is a disallowance similar to section 40AIA. So that is considered as actually it's not a disallowance, it is a deemed application, deemed income. If you don't do TDS, it is a deemed income. That comes as a thing here that you will find here. Income as per explanation 3B, while section 40AIA he is bringing here. If you see item number 5, amount disallowable under section 11(1). Though it is considered as disallowable, it is like a deemed income. If you see the computation format, it is called a deemed income. All these situations could result in a taxable tax liability for the organization. Maybe practically, I have never seen a situation, but these are the things you have to be alert now. And this computation beautifully computes the income. Gross income after exemption under section 11. So if you see this formula, 1 plus 5, 6, from there it is 1 plus 5 is the total receipt. You are seeing here, 1 plus 5 is the total receipt. From there it is minusing all the application and then adding back all the addition. So you will arrive at that income for which there is no benefit of section 11 exemption. Then comes the next part. You see here. Next here, income not forming part of 9. So up to 9, all the section 11 rule he applied. Okay. Then here comes your other income, which I told you. Do you have a taxable income and you report house property or capital gains? That comes here. Income from house property. This will be your regular house property computation, regular business income, regular capital gains, and finally he arrives at your total taxable gain, tax amount which is taxed at maximum marginal rate. Because it is a public charitable trust, ITR 7 means it is a charitable trust where shares are not determinate, so income is taxable at maximum marginal rate. So finally he arrives at the, if at all comes, the income taxable at marginal rate. So this schedule, part B, TI and TI is something worth exploring. You will get a complete understanding of the whole section 11 and section 12, section 13, and in what context, in what are the violations, in what context the trust can have a situation of taxable income. So this is a beautiful consolidation of the whole thing. And tax liability, then regular tax relief. It's a regular computation, just like for-profit organization we compute, it's a regular computation. Then from there, TDS, removal, all those things, so on and so forth. So this is something I wanted to tell, 530, and so all this rest of the new things are relevant if there is a capital gain. For example, if you have a capital gain, there is a table where they specifically capture capital gain details. There is a table specifically they capture income taxable at special rates. Okay, all those are there. Other than that, even for income from other sources, the dividends under various categories, 150 series, there are various categories of dividends, income from units of mutual fund, all those I don't expect common for organizations, because most of the organizations which we file return will be compliant with section 11. If there is a violation and if there is a dividend which is not in the regular category which enters section 11, then there are tables where you have to report for other sources. Then other than that, there is nothing new in the return. All those are income taxable at special rates, capital house property, tax payments, that's all. So this is the income tax utility. Now, I think, how many of you use Winman software in your office? So it will be useful if we can make a quick glance of Winman, right? So he can help you on that Winman software, how it is coming. In the Winman software, what they have done is, wherever there is a amendment, the key changes, they have come up with new is there. So if you click that new table opens, so he will show you that. That will be helpful, and after that we can take up questions. Or if you want to finish questions,
yeah, questions.
Yeah, sure.
Schedule J. Schedule J.
Yes.
See that you are saying that corpus investment. Corpus investment may not match with the donation fund, because sometimes the fixed assets they will give.
So if you are able to see, corpus comes with a specific direction forming part of the corpus of the trust. Suppose there is a building corpus. Then in the balance sheet, the other side, you should be able to tell that it is invested in building. Then there will be a mismatch, so that you should be able to tell that it is in the form of a building. That situation can, or what you have to do is, from your regular corpus, you have to remove that and show separately somewhere else in your balance sheet.
Apart from that, there will be some more mismatches of it. The organization is there for last 20-30 years. Sometimes we may have used the fund.
Yeah.
Some
That only they want to capture, sir. If you have utilized the fund, what they say, earlier years there was no rule. Now earlier years, how we are going to recoup is really a question. Practically we have challenges here. Whether with that mismatch, whether the return will get filed, we have to see.
Is there any way out shortcut?
Maybe if it is not at all getting filed out of the bank balances. See, deposit in scheduled bank is also an allowed mode of investment. So that unspent money sitting in, you may not have made an FD out of your corpus fund, but it is sitting in your bank account or in the form of an advances, you can mention there. Because basically the mode of investment, they want to make sure that you are not putting, the organization is not putting money in capital market or other than specified mode. That is the purpose. If there is any shortfall, if it is there in your bank balance, you can show that as a corpus fund. Accordingly, in the financial statements, you may have to explain. This being the first year and already the organization has finished, March is over, we have challenge there, sir.
But how to show if it is in the form of any asset? How to show it?
So if there is a mismatch, there will be a mismatch, validation error will be there. There you can show in other mode that put that amount there, sir.
Other mode.
Other mode. You match if it is without the number being matched, if it is not getting filed, you put the number which is put it in the billing and also file the return. Then income tax officer come back and ask, you can explain. It's only way.
Some other fund we can mention here.
Yeah, we can mention.
And in the
Because there is no remarks column, unfortunately.
yeah.
Or we could have mentioned that. They have envisaged the situation only the money can be in bank account. Yeah.
And similar case for the balance sheet also.
Yeah.
You says grant accounting.
Yeah. Yeah.
Grant accounting also it differs from for income tax purpose one method of accounting, for filling up this form will be another method, and for IT computation will be another method.
Yeah.
In the case of IT computation, total 100% grant amount will get taken. And if I am taking 100% amount, there is no left out for balance sheet purpose.
So what happens is, yes, see computation you apply the deeming fiction. But in balance sheet what happens, you will recognize your grant only based on the expenditure incurred. If you are following the income recognition as per accounting standard 12. Then your income and expenditure account will have a number, but in the IT return we are reporting based on receipt and payment and balance sheet. So your accumulation may not be equal to your unspent money, if you are trying to ask that question.
Exactly. So in that case, balance sheet will not matter.
Yeah, you will have everywhere same number may not be there, definitely may not be there. But in the balance sheet, in the own funds, any other reserve, there that unspent project grant you have to bring in. If in your balance sheet, in your method, actually it will be sitting in current liability. Yeah, but you have to bring in here, sir, as a part of own funds. You can't report under current liability.
We have to bring it here.
Yeah, because current liability has only sundry creditors and payables. Because in this balance sheet, his approach is that all the voluntary contribution is the fund of the organization. They have never envisaged the situation of grant being undischarged obligation and being a current liability.
Okay, in that case, the numbers will not match between the schedules. There will be mismatch.
There will be mismatch. Because your computation, you are taking, as you rightly said, at the point of receipt, my 15% and 85% starts ticking. Whereas in my balance sheet, if I am following the recognition to the extent of obligation discharge, that unspent money, your unspent money and accumulation may not match.
Okay, here also we have to bifurcate year-wise how much corpus fund, general accumulation. Again, it will be a tedious process of doing for last 20-30 years.
Yeah, 20-30 years, see, unless there is an year-wise details, they are asking only for accumulation, sir. They are not asking for corpus.
But it's very different from the balance sheet to take out the numbers.
Yeah, I think we should take the balance sheet and start filling the numbers. That's the only way out. What I foresee is, as the first question of yours is very valid, because unless they have matched the corpus fund and corpus investments, it's going to be a real challenge, and if the money is sitting not in the form of bank balance, we have a problem. But actually the mandate is that, sir, especially for corpus, no sir, I'll tell you. The 85% stricture is not applicable for corpus. So they have enjoyed the benefit of, that application responsibility is not there. So they really want to see that corpus. They can't use the corpus, and they want to really catch that point of, have you used corpus? Because at the point of receipt, you didn't apply 15% and 85%. But you took that money and spent and showed as application. There is a mismatch, right? That is why they told that unless you put the corpus back, we will not give you the benefit of application. So you may have to go to previous 3-4 years to see what really happened with corpus. That work is there, sir. You are right.
Investment accounting also, as per accounting standards, we capitalize the premium, everything, and amortize all those things. In that case also it won't match.
Yeah. Balance sheet and that computation will not match. In fact, that is why actually earlier ITR 7 was not asking the balance sheet. That made sense because they are, as far as income tax mandate is concerned, your method of accounting is not bothered. No, he only wants to know whether you have spent the money. Now with this balance sheet in place, what they want to capture, we have to really see and wait. That is why that validation checklist is very useful, I thought. What all he wants to cross check. Yeah.
And is it cash basis of accounting is mandatory or is only a voluntary?
Cash basis of accounting is not mandatory, but for Section 8 companies, accrual is mandatory. Under Companies Act. Accrual basis of accounting is mandatory for Section 8 company because they have Companies Act compliance. But the computation you make as based on receipt and payment account. So for a Section 8 company, you will have income and expenditure accounting compliance with Companies Act with the depreciation, provision for gratuity and all. But computation you make based on receipts and payments.
Section 8 company also.
Section 8 company. I am talking about Section 8 company only. Because other companies ITR 7 will not know.
No, I mean to say trust and...
Trust is you have a choice either to follow cash basis or accrual basis, but again computation is based on receipt and payment.
Yeah, similarly in the case of Schedule BC, even FCRA donation and India donations when we give, for FCRA purpose, it will be cash basis of accounting.
necessary, sir. I mean, again, depending on, see, there is no stricture that you should follow that method of accounting, but in the FCRA what happens, that certificate we have to keep, right, as a chartered accountant, what is your opening balance, how much fund received, that FC4 return what they filed. Yeah, so that is based on recipient payment account only.
So same code has to come here also.
Yeah, ideally, because there cannot be a different number. If there is a different number, at this point they are not cross-checking with FCRA return, but that is not far away. So, what you can do is a reconciliation. If there is any difference in numbers as to what is reported in IT return and what is in FCRA return, then there should be a reconciliation. Even when filed that form 10BD, basically they told that it is for ATG, but what we think that, because if you see here, first stance, we thought that those who are not eligible to claim ATG, or rather, for example, a foreign donor is not going to claim ATG, so full FCRA donations and grants can be outside the purview of Form 10BD is the stance what we took first.
Yes.
But some of the speakers which I heard, and also the opinion is like, you don't bother whether the donor takes ATG or not, because in the drop down you don't have anything other than ATG or Section 35. Others they don't have. If you report the amount, you have to choose ATG. So they were saying that if the intention of the department, because they didn't stop only with PAN number, including passport number they asked. If the intention of the department is to map your gross receipt, you know what is your total gross receipt in your ITR 7 versus what is reported in Form 10BD. We don't know whether they will come back with a reconciliation process. We don't know.
This 10BD is mandating or the institute got ATG 23F approval, ATG 2.
Because
But they also need to file Form 10BD.
yeah, ATG approval in all the organizations they have given. I don't think they have
ATG
given
5 only.
ATG 5.
Yeah, Form 10BD says
Form
that the
10BD.
institute got approval under ATG 5.
That 100% category.
No,
No,
no.
50% category. They only have to file 10BD.
Subject to maximum.
That are non-charitable.
It is chargeable,
Hmm.
but there are ATG 2, 3F.
But I don't think they have given any specific exception for that Form 10BD. No. Yeah. Other than that 50% category they can claim the donor. Only for them it is applicable. There's for the ATG. Yeah.
100% category.
No, because the ATG is a clause 5 only that 10BD they introduced.
Correct.
Yeah.
So in that case, we are getting 100%, no need to pay.
Yeah. Because in that there is no, that specific clause is not mentioned in that Form 10BD. ATG is a clause 5 is mentioned in sir.
No, they mentioned just ATG one.
5 is there.
Where is there?
I don't know. Form 10BD. Let's see. ATG 5. Under Form 10BD it says the section 85.
No, in the drop down list it is ATG and 35, the two sections. are-
ATG surplus 5 is there is my memory, sir.
Yeah, no problem.
They are given 4, 5. Even 35 also surplus.
35 is there.
No,
35 is
35 also
there.
surplus is there.
80G. 35 is there, but 80G surplus 5 is the one which has is my memory, but I missed.
Madam, we can go to proceed.
Yeah, we will- I will answer you
You
then.
proceed, you know, it is there, it is, you can see that.
But I'll answer your
No,
questions.
yeah, thank you.
Madam, one more thing I wanted to ask you, this MMR, this maximum marginal rate, it will be like 42.74.
Yeah, including that higher surcharge.
Ah, it will be 42.744.
Yeah.
Oh my gosh. Not
Actually, in
50%.
fact, if you don't give the surcharge, you will get a notice with the demand of surcharge.
Yes, and notices are coming for that.
Trusted taxation, huh?
Yeah, therefore, the MMR is 42.744, including the maximum surcharge, 37%.
Yeah, that is
Good evening all of you. So this is how the demand form looks like. So all these are the common things. Let us jump into the ITR part where the main changes have come in.
Please, just 1 minute.
He is Kaushik, he is my partner. He actually, his areas of interest is more into GST and also this, he does a statutory audit, income tax, everything. So, since he filed 4-5 returns in his new ITR 7, I thought his inputs will be valid.
Thank you, ma'am.
One question. In case of unregistered trust, how to deal with the expenses? Is it allowed or not?
Unregistered trust,
Yes.
no registration under 12.
Yes.
So now you have to file ITR 5 side, it is a trust.
ITR 5.
So normal P&L account you have to file. But you can manage in such a way that if you get approval later, no, within the financial year, you have to file ITR 7 now. Suppose if you have unspent, then you have to file Form 10 at that point. Expenses like normal expenses you can do.
No, my income side is interest income. Expenses is donation. Can I set off the income?
Now donation, no, if there is no section 11, donation is not an allowed application. Regular donation is a disallowance, no, sir, under regular computation. You can't claim that as an application. Profit as per profit and loss account. Section 37 donation gets disallowed.
That's what I
Section 11 will not come. The regular profit and the chapter will come.
Profits in the
Yeah. Donation will be disallowed, sir.
normal provision of that.
Hope everybody can see the screen. So this is one of the new field, that is the deemed application. All these years it was not being asked, now they are asking this. As we understood previously, this is applicable where you have received the funds in the last moment. Say on 31st of March you have received the funds, we are unable to utilize the funds, or due to some other reason you are not able to utilize the funds, but you know for sure that that amount will be spent in the next year. Then we have to fill in those details here, and they'll also track that amount whether it is applied subsequently or not. So if you see here the financial year, amount deemed to be applied, reason they are asking, amount required to be applied in the current year, amount applied in the current year out of the deemed application, deemed income, and amount applied in the future years. Suppose if it is not applied, what will happen? It will become a deemed income. So this information they are capturing here. Form 9A has been filed or not. This is a basic requirement. If we have to claim it in the next year, then we have to file the Form 9A. So whether it is filed or not, they are capturing it. So going to the next table. It is the nature of business. See, now they are capturing what is the nature. See, all the charitable organizations can have certain business activities. Only those charitable organizations which is having general public utility that link, they can have the business transactions only up to 20%. So in those categories or the other categories, we have to mention what is the nature of business. So they are capturing that data here. This is the details of corpus fund. So they have given the two bifurcations, renovations or repairs of places notified under 80G, subsection 2, clause B, or other than the above. See, they are asking us the opening balance applied during the year, whether the amount is plowed back, amount invested or deposited back to the corpus, not claimed as application earlier, amount invested financial year in which it is applied, and closing balance here they are asking, and the non-spent amount whether it is invested in the specified modes or not. So from this table, what do we understand? So we understand that if we take out some money from the corpus fund and utilize it for the general purposes, then in that year we cannot claim it as application. Only in the year in which we are flowing back our corpus back to the corpus, only in that year we can claim it as application. You can see a financial year in which it is applied. When the amount is coming back, we should mention that year, and in that year it will be considered as applications. This table is meant to capture that data only. And the other corpus, whether it is invested as per section 11 subsection 5 or not, they are asking here. And this amount, they will do a cross check with the specified investments in the balance sheet. So we should be careful that this amount, whatever we are putting here, also cross matches with our balance sheet investments. The new thing is this loans and borrowings. As we all know that due to some reason, if the organization does not have funds, they will take some loans and use that money towards the objectives. But that the government is not treating as applications. So what they are treating it as only in the year in which we are repaying that loan, only in that year they are treating it as applications. So this table is designed to capture that information. So particulars, opening balance, from whom we have borrowed, opening balance, loan borrowed during the year towards the objectives, applied to during the year towards the objectives. See, application also they are capturing, but the next thing is important. Loan repaid during the year, not claimed as application earlier. Amount repaid and the financial year in which we have applied. So though we have applied it, it is not useful. Only in the year in which we are repaying it, it will be considered as application for us. And the other details are asking whether it is invested in subsection 11 subsection 5, that is a specified investments mode or other modes. These are all the normal things, these are not the new things, but one thing that we should know here is, see, whenever we are telling we are making some investments, these amounts are getting cross-verified with your balance sheet figures. So we should think, we should prepare our workings accordingly and match these amounts in the investments into the balance sheet investments. All other things are the same old things, but let us see what is new. What are the incomes exempt under section 10, except under section 1023, 4 and 5, 6A? What are the other exempt incomes they are capturing here? This is a new thing that they are asking. What could be the examples? Anybody can tell? If the trust has got any other business and those incomes are exempt, means those things will come here. Example, as one person told, it is agriculture. So this is the basic bifurcation, that is establishment and administrative expenses. So this they are capturing it. And the next thing is towards the objectives. Expenditures on the objective of the trust. So as ma'am suggested that this information they will cross check with your approvals. So if you have been approved under say education, are you applying it towards other limbs is what they are checking here. Some expenditures are not allowed as applications. We should give the information here. Examples could be depreciations, your non-DTS transactions. All those things will be coming here. See, all this while the general understanding is that based on the RNP only we have to fill this. The government also brought in this clause to see that whether the amount is actually paid or not. So they have inserted this thing. So if suppose you prepare it in an accrual system and you fill everything here, then also this clause is there whether the amount actually not paid out of the account. If it is not paid, it will be removed from the applications. So generally the form was designed that based on the cash method or the RNP method only you have to fill this application or this ITR form. But now they have brought in this clause to make sure that the form is filled based on the cash method only, not based on the accrual system. See, another thing, add expenses accrued in the earlier years but not claimed as application, paid now. Suppose some payable is there, and that is paid during the current year, that gets added to the applications. Similarly, in the capital, capex also they are giving those two categories, amount not paid out of the above and amount expenses accrued in the earlier years but not claimed as application, paid now. So as we understood, this is the revenue segment, this is your OPEX and this is your capex. And the whole new thing is that is the IDR balance sheet. So as you can see, this whole segment is a new addition. This was not there previously. So we have to give the information here, and as you can understand here, this is not the general balance sheet that we follow. They have given only certain fields, and only we have to fit the items into these fields only. We don't have any others or any other new categories, we cannot fill it. So whatever balance sheet you are having in your tally or in your accounting software, you have to accordingly map it to these items only. So whatever is your current liability, unspent grants, where should you put? You should put it in your own funds only. But because at the point of receipt, the intention is that it is your money, you are willing to spend it. It is your money which you have received for the objectives of your trust. So therefore it should be categorized under own funds. And if you see here, there are no much items here. If you see other profit and loss, other balance sheets, there will be multiple items. So here, since the items are less, we should see and group this accordingly. And apart from this, this is the new thing. If whatever the own funds that you are mentioning here, that you should categorize it in this table. See, some of the fields are auto-populated. See, whatever corpus you had keyed in above will come here automatically. Only these two numbers you have to key in, and if there are other things you have to key in here. See, what is the other the numbers that we have to key in? Accumulated income, 15% of the income on which mandatory it is not to be applied. Accumulated amount under section 11 subsection 2 or 1023, third proviso. This is your 5 years applications. So only these two things you can fill it, and other things you can put it under other reserves, but you should give what is the nature of that own fund. Similarly, this investments, see, this is the place where you could do a cross check. This amounts.
That you said, no, 5 years, whatever obligation you have to fill up, that means that has to be recognized in the balance sheet, you mean to say?
Under the own funds.
No. See, that,
Yes.
that one, you have to recognize. See,
Yes.
You have to because see
no,
that money
generally in income tax, you declare it to the extent of shortfall for the 85%. Okay. So that has to be recognized in the balance sheet.
So in the total that that unspent, it is basically it represents your unspent money, no sir.
Yeah.
So it will be there in your balance sheet.
Oh.
Definitely no sir, because what is
Since the money has come to you, it should be in your balance sheet. It is unspent, therefore it should be there in
It
your
would have gone out
balance
of
sheet.
your bank account and gone, no sir.
Correct.
So in the in your balance sheet, that whatever you have received and not spent is sitting in somewhere that they want to get. That is the problem here. That own funds they are expecting you to see. If you are saying I have accumulated another say 3 crore for which should be spent in next 3 years, that 3 crore should be there in your balance sheet in some form.
So you have to bifurcate some amount and put
that's
it
it.
here.
Yeah.
Saying that.
I am sure that all these years we have that what I should say overall method worked.
See, maybe it is some FD is there, big amount, some amount you have to partly
Or
put it
it may be
here.
some opening balance of advances or TDS receivable. Put in whatever form we don't do. I mean, all these years it went in overall method.
Yes, overall it is.
No one-to-one method. If you see any
And balance sheet was not asked at all.
that's all. And also any 10 years old trust if you take, if you really apply your mind to the balance sheet, there will be some money which has come which was never spent. The entire salaries and expenses was taken by grants and the general donations was never spent. It is possible.
Yes.
But in the computation, the expenditure from the project took care of the 85%. Now, one-to-one, it is like showing as if he wants to see really you have any unspent money. We don't know.
So this is the last thing, this is the investment details. They want to cross-check this investments with this investments. So wherever, whatever investments you have made, that is your corpus investments, or your 5 years accumulation investment, or your other investments, all that they want to cross-check this with this.
Actually, that
This is,
investment
it comes automatically, it comes populated in other corpus, other investments, and this should match with that. If not, your software will throw an error on it.
Yesterday we had a situation where the money is sitting in bank balance, so we put balance with banks. In the balance sheet there is a line item balance with banks and we put the money.
Correct.
Then it is telling, and down the balance sheet there is an additional data. What is your own funds comprises of? So it is telling that you have told that you have invested your money in the specified mode, but in the balance sheet your investment column is blank.
Right. You have to
So from
reduce
the
there and you
balance,
have to
from the bank balance,
balance,
you
you have
can
to
show it
budget
as
and put that
investment.
side.
You have to reduce and trade.
Yeah. So one fine learning is we can't do this on 28th July. That is the thing which I can think of, the practitioners like us, and we can't rely on even a best article in the office. definitely partner has to sit, because partner has to make an exercise, and now in those cases where the organizations have finished and signed balance sheet, now we can't change the numbers. Now it is really going to be a reconciliation part at the time of what is reported in the return, and we should have a working paper, you know, after
Excel
2
sheet you have
years.
to keep
Yeah,
first.
exactly. After 2 years when they come back, no one is going to answer, I think partner is only constant. Articles will go. So full sole responsibility, finance managers will go, trustees will change, everything will change, only partner will change. So for our interest, we have to make sure which an Excel sheet which we understand. I call like that in my office. Don't give me an Excel sheet, but I should understand. I should write my language. What
Like
does
how
it
you make computation sheet, same.
Thank you all. Any doubts? Anything?
Sir, I have
Yes, sir.
ATG, I got an answer. It is ATG 5 clause 8. So in that clause 8, specifically that 100% category is not coming in clause 8, sir.
You can see
I
here.
will show you. It is very clear.
This form you can see here. It's ATG 5 clause 8.
So all your public charitable trust which has approval and where the donor gets a benefit of 50% will fall in that category. It is very clear in ATG.
Yeah.
It's there only.
And last part, that verification you can tell. Who can verify the return? So through DSC, through Aadhaar OTP, and trustee, or sometimes even CFO also can. Only thing in the new IT portal, you have to add it as key person. There is in the profile there is an option called key person, and you have to choose who can verify the return. So it is not a simple process. Including that level, we have to make sure, because all you have to imagine, you are in the office on July 28th and 8 o'clock filing the return. OTP, DSC is not working, it is not renewed, and last 5 years this person was submit again, this system not working, that system not working. The possibility is you have to go to the profile. I think that homework we can do at this point of time. Who is going to verify whether that person is available on the date, what you are, the next 2 weeks, whether they are available, you have to see. They would have traveled. And correctly, now midnight 8 o'clock article cannot call, sir, OTP you can't say. You know, so all these things, as I mean, we have to, as partner, we have to foresee all these things. So you have to take action, imagining things, not based on your experience.
Okay, thank you all.
Madam, just one more question.
Yes,
There's
sir.
a technical guide of our institute for
Yes.
non-corporate entities, that format. Do we have to follow that from June
No,
3rd?
sir. Actually, that we are following. To be honest with you, it is so far financial statements officer has not applied my mind, and even during the scrutiny, he is only bothered about your application and Form 10. For the man is because, especially if you are working with charitable organizations, the board will consist of the people who are non-accounting people.
Yes,
That
yes,
is my
yes,
experience.
yes.
And chartered accountant, you are expected to explain the balance sheet. So you can't use the expression accounting terms, you know.
Yes, absolutely.
So
Very
that
technical.
restricted and unrestricted. So the principle what we are driving is the organization cannot have a surplus or deficit out of restricted funds.
Yes.
Because it comes with a structure. Any surplus or deficit is out of unrestricted fund. That is the golden principle.
So then you
But
follow
now-
the fund
because
accounting method.
somebody is giving you money. Actually deliberation is interesting, because somebody is giving you 100 rupees, say that you please spend full 100 rupees, right? That is a project grant. Now when we compute the income, we are putting a deeming fiction of 15% is yours and 85% you have to spend.
Yeah.
So it is not mandatory, sir. It is only recommendatory for better presentation of the financials, not mandatory. Now I think the form will dictate what way you will make your financials. Or at least you should have one set of financials specifically made for ITS.
Thank you. We have come to an end of excellent session and also the full day program. So actually I had promised that we'll be leaving early, but I think the members' interest kept alive. So also I would like to make one announcement that the registration for the 2 days conference is open, state level conference is open, which is to be held on 19th and 20th. Please do register.
August.
Yes, which is in August. Thank you, ma'am. Thank you for taking your time out and coming. And special thanks to members also. After a long time, we see such a huge gathering. I think most of the time our members prefer to stay at office or at home and have a peaceful interaction. But I think this makes more sense because you get your full attention here. So that was our intention, and we would like to have this continuing support going forward as well. Please, thank you once again.
Thank you, madam.
I request Chairman of Bangalore branch to hand over the memento to the speaker of the day.
Thank you so much.
Thank you.
Actually, I am very thankful to Srinivas because, as I told you, so seriously, I never read ITR 7 and all the struggles will happen only on July 27th or September 29th. And there, all the shortcuts we have to put and all the accountability and onus falls on the partner. So that way, I am very thankful to Srinivas that he told me actually 1 month before. But the schema, the latest utility was released on 6th July. Even this date I can tell with so much confidence because of this session only I opened and saw the IT portal. In our office we use Wingman. And one thing which we found that some places the Wingman is not fully equipped. For example, last financial year Section 8 company, if you choose, you have no option to choose domestic company, but that bug has been plugged this time. So thank you so much, Srinivas, for giving me this really great opportunity. And at this point, I want to acknowledge my thanks to my partner Rekha. She's one of the founder partners. Whatever I spoke today, I learned from her only. There is no doubt on that. So, ma'am, thank you for all the guidance and support. Thank you.
On behalf of Bangalore branch of SRC, I thank each and every one of you for actively participating in today's conference. Thank you.